It's 6 o'clock in London, it's 1 p.m. in New York. Hope you're enjoying lunch. It's 1 a.m. in Hong Kong and 3 a.m. in Sydney, 10 a.m. in the morning in San Francisco and 10:30 at night in Mumbai. For the second week in a row, if you're watching us by flickering candlelight with a generator, giving you power to access the interweb. What else can I say but good morning, Texas? Not sure this week whether it's still the hangover from the weather leading to the power cuts of last week, or whether you're just using candle power to assuage your weather bills. Whether it's those power bills or anything else, greetings, good morning and good afternoon and good evening, depending on where you are in the world today. Ladies and gentlemen, my name is Patrick L. Young, the IPO video live stream. Series 4, Episode 3, we're coming of age this evening. It's number 21, starts here. Bond folks, with perspective, may have been perturbed by the style of the news, more than actually the news itself over the course of the last week, when we heard a lot of giddy reports that, well, overnight, the US Treasury 10-year rocketed, and similar hypey emotive language was used, to a giddy 1.3% yield. Moreover, ladies and gentlemen, the yield curve was declared to be steepening. I was left thinking, something which starts at a handful of basis points on 1 month and ultimately reaches 2.08% for 30-year money is an appropriate Shrove Tuesday yield curve. By historical standards, it looked as flat as a pancake to me. And of course, don't be pedantic. I mean, things have got, immeasurably worse during the course of the week in the world of the bond market. Good grief, by last night, the 10-year bond yield had risen to 1.4% and the 30-year to a whisker below 2.2%. Good grief, 80 basis points for 20 years of risk, please. Meanwhile, of course, over at the Bank of England, they've got one of the leading panjandrans there. He was pointing out the fact that he doesn't think that he'll ever see 5% interest rates again in his lifetime. Meanwhile, in signs of a bull market for the weekend's virtual cocktail party discussions, number umpteen, I particularly like this magnificent headline. What is up with Nepali TikTokers pretending to be share market experts? Well, are Nepali TikTokers the new shoe shine boys? Oh, that harks back to that excellent conversation we had with Dominic Frisby on the IPO-VID just a few months ago. All this and more, ladies and gentlemen, much more during the course of the past week has been covered in greater detail in Exchange Invested Daily, the unique newsletter of the Bourse of Business. If you'd like to read more and become a subscriber, send us an email, hit me up on social media, wherever you're watching this today. Patrick L. Young's the name. And we'll be delighted to get you signed up for a 30-day free trial. Meanwhile, of course, ladies and gentlemen, let's share the love. I mean, I know we're coming up towards Easter, and one of the great things that is happening in the world at the moment is the fact that we are gaining subscribers by the week. We are gaining viewers by the week, but we would still love you to share a little bit of love. Please, 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 may we have a little bit of love along the bottom of your social media feed. Hit that like button, ladies and gentlemen, and let's get this show all the way up so that we can pay tribute to our magnificent guests. Speaking of which, this evening we have Dr. Richard Smith, the Doctor of Uncertainty. What an epic title, ladies and gentlemen. Dr. Richard Smith is a Berkeley mathematician and a PhD in systems science. He's a fintech entrepreneur and CEO of the Foundation of Study of Cycles, an organization in my youth I used to read with great interest many of their publications. Dr. Smith has built a reputation as the Doctor of Uncertainty amongst his academic peers, and he's helped government agencies and Fortune 500 companies, including the likes of Pfizer. Gosh, there's a company you don't hear much about these days in COVID times. And the likes of Johnson & Johnson make sense of complex sets of data. He's an expert in risk management. He can provide us with critical insights. We're looking forward to that this evening, to help empower investors on all levels. Some of Dr. Smith's findings are just, well, what can I say, ladies and gentlemen? Stunning. His empirical data-driven proof that even the world's best investors, from Warren Buffett to Carl Icahn to David Einhorn and many, many more, could see their results significantly improved through the use of technology that helps course correct irrational tendencies and cognitive biases. What an interesting concept that Warren Buffett has some irrational tendencies, apart from his McDonald's and Coca-Cola fixation, of course. Dr. Smith's software is backed by proprietary algorithms and a Nobel Prize-winning research. He served over 25,000 investors and helped steward more than $20 billion in assets. Good evening, Richard. It's a pleasure to have you with us this evening. Where in the world are you today?
I am in Southwest Virginia in the Blue Ridge Mountains, and I was on a generator with candlelight last week.
Well, I'm absolutely delighted we didn't have you booked for last week then. That was such a joy that we had a completely different guest in our paradigm. Thank you for that, Lee Hodgkinson. Look, very interesting. I mean, one of the things that stands out for me instantaneously as someone who's always been interested in the history of investing, always fascinated by, an ardent student of markets like myself, the foundation for the study of cycles in itself, an evocative, interesting name in the history of financial market analysis.
Absolutely. And 80 years old, we're just celebrating our 80th anniversary. We just published the 80th anniversary issue of Cycles magazine. It's free online right now at cycles.org. We were founded by Edward R. Dewey, who was a polymath of his own. He was the chief economist in the Hoover administration, and he was tasked with trying to figure out what caused the stock market crash of 1929 and the ensuing depression. He talked to 100 economists and got 100 different answers and decided to start looking in other directions. And he discovered cycles in the markets and then started to connect those cycles to other areas of nature and life, including wildlife populations and other cycles, and started the foundation for the study of cycles with a pretty illustrious board, including chairman of the Smithsonian and a number of other significant leaders of the time. So it's great to be bringing the foundation back to life and helping the public reconnect with this worthy institution.
Absolutely fabulous. I mean, it's great to hear, because Dewey, as you say, was a legend in markets at a point in time when we had so many people who were looking beyond the pure ability, possibly sick brackets, of the economists of the time of the 1920s and 30s to try and make sense of these sorts of things. And it certainly strikes me as interesting that you're saying you're 80 years old this year, so that's what, a Kondratiev wave plus a decent Fibonacci retracement, which makes obviously for quite an interesting cycle in itself. And the whole institute has been through incredible times, yet the cycles still seem to remain remarkably relevant.
Yep. Well, I actually think Dewey was one of the original behavioral economists. So I think Dewey, he certainly was somebody who was deeply interested in and passionate about data. But I think he also was looking beyond data and trying to understand patterns more broadly. And I think that is a very relevant question today. Dewey would actually, of course, be beside himself with the access to data and analytics that we have access to ourselves today. But, how do we actually connect that data to our lives and what's going on in the world? And, it's not just all data. So we do need to study the data. We need to find the cycles, but we also need to kind of connect them to, the bigger picture.
Excellent. So therefore, ladies and gentlemen, you've got 1 hour this evening to connect to the bigger picture through cycles. What would you like to ask the Doctor of Uncertainty, Richard Smith? He's here. Just drop us a question on whatever social media you're watching us through this evening. We're live on Facebook, LinkedIn, and of course also YouTube. So looking at the center of, the Center for the Foundation of Cycles, what is your process at the moment? What are you actually trying to get out there in terms of the message of the cyclical economy, as it were?
Well, we certainly have technology of our own that uses digital signal processing and Fourier mathematics to detect cycles in time series data. So you can go to the Foundation for the Study of Cycles and you can look at different indices or economic indicators and detect cycles in them. One of the big ones we were looking at over the past month, Patrick, is the NAIM data, NAAIM, National Association of Active Investment Managers, and how long they are the market right now. And they are as long as they've ever been in the 21st century. I think almost 110 or 120% long the market. So, leveraged long, and that happened. It tends to peak about every 184 weeks, so a little, maybe 3.5 years, and those often tend to coincide with tops in the stock market and bottoms as well. So a lot of our data and a lot of our analysis does suggest, that we're closer to a topping in the economy and in the stock market right now than we are to a bottom.
Interesting.
So we do that kind of analysis.
That's quite intriguing altogether. I mean, looking at the cycles, and certainly one other statistic I noticed this week, which was fascinating, was in a month where you cannot seem to manage to read any positive coverage of Turkey, I noticed that foreign investors are now holding the least Turkish equity in history. So who knows? Maybe there's a big sell America buy Turkey trade on in the short term. It's fascinating to look at the data that emerges from these sorts of spaces. So tell us a little bit about yourself then. You're running the Foundation for the Study of Cycles these days. You're a polymath in your own right. You're really a very highly credentialed mathematician. When you look at the whole issue of where we've got to with the markets and cycles and so on, how did you get here? How did you get involved in the foundation, and how did your career evolve?
Sure. Well, I think that where I've been really interested personally for a long time is kind of in the relationship between models and the real world, right? So my PhD work was in information theory, essentially, and decision making under uncertainty. And so you'd have all this ability to model things and to even model the things that we're uncertain about, that we don't, know how it's going to turn out yet, right? But yet, we put a lot of false information into those models. And how do we be more honest about the uncertainty that we face in decision making, and not kind of let bad assumptions propagate through our seductively, mechanized decision-making process, right? Which everybody who participates in the markets faces this dilemma, right? We all want to use data. We all want to make decisions based on data. But how do we really acknowledge the uncertainty that we face, recognize that the model is not necessarily reality, is not reality, and how do we manage that interface between models and reality? And of course, the markets are a wonderful place to do that. And I think that that is what Edward Dewey was interested in too when he started the Foundation for the Study of Cycles.
Fascinating, absolutely intriguing altogether. Ladies and gentlemen, we've got a question for Richard. Just drop it into the comments. We'll be delighted to answer it. So moving from the Foundation for the Study of Cycles itself, I mean, you've obviously had quite a large media footprint, partly as a result of the foundation and so on, and that's driven you to have a huge interest because, well, you've become very, very heavily engaged with the retail investing fraternity. Yeah, well, I've always been interested in, I am a retail investor myself, and I have always been very passionate about the opportunity that retail investors have to really engage in and benefit from involvement in capital markets, right? There's all this talk going on about democratization of markets right now. If you've been following GameStop and Robinhood, et cetera. I was just listening to Larry Tabb from Bloomberg talk to Doug Sifu from Virtu, right? And talking about the democratization of markets, that access to markets is democratization, and lowering transaction costs gives access. I'm not so convinced that is really the holy grail for the retail investor.
And I, I really want to see the retail investor engage in our capital markets and succeed in our capital markets long term, and just having access doesn't equal success, and having free trades and low transaction costs doesn't equal success. So this is something I'm really interested in talking with you about today, Patrick, because of your knowledge of market structure. You've been an insider in the markets. You've seen things from the inside out. And I think there are big questions today around how are we as the public, going to really engage, not just in markets, but I think in the economy more generally, more broadly, in an effective and successful way where we're not simply kind of being, feeder fish for the sharks and whales.
Well, what always interests me, and it's always been my constant, I suppose, bugbear with the financial industry, is you look at the way that it treats retail investors. And I mean, if you go to hospital and you've got some monumentally terrible disease or illness and they're about to do surgery, somehow or other, the surgeon always comes around and he sits on the side of the bed, and no matter whether that's big or small surgery, he goes, well, we're gonna give you a bit of a sleep, and we're gonna pop something in, and we're gonna do this, that, and the other. And I remember getting my wisdom teeth out many years ago, and it was like, well, we're just going to set you down, and we're going to have to pull these teeth out, and then you'll be a little bit sore in the morning. That's okay. I mean, what they don't tell you, of course, is the fact that actually Nurse Ratched is holding your neck bent double over the back, while some psychotic guy has 4 feet pliers and a power drill in your mouth, which is certainly how it feels a day later. But the point is, they're capable of explaining to you what's going to happen. And you look at the finance industry and you ask anybody anything in the finance industry and they all go, it's complicated. I'd love to tell you, Richard. You're a nice guy, Richard, and you've been to this place called Berkeley or wherever it is. Did they teach you? Okay. Oh, you did math. Oh, okay. And that's the thing that I find incredible about the finance industry, because the finance industry spends a whole period of time building its mystique. And I always think it's just insecurity, and I find that really funny. But
I think it's a lot less complicated than most people make it out to be. So my first big aha in the market. So I started this website in 2005 called TradeStops.com, and it was a trailing stop loss alert service. So it sent out alerts, hey, you're tracking a 25% trailing stop. Your stock just fell from $100 to $75, and I'm letting you know that you hit your trailing stop. And this was before they were available in the brokers, et cetera, right? And through that, and then through my background, my PhD research, where I'd studied Kahneman and Tversky and prospect theory and decision-making under uncertainty, I realized that what was going on with most people in the markets boils down to loss aversion, right? And this is what 2 Nobel Prizes in economics, first Daniel Kahneman in early 2000s, and then Richard Thaler, now he's at MIT, that we hate to lose. Surprise, surprise. But the fact that we hate to lose has different consequences depending on whether we're underwater on an investment or we're winning on an investment trade. Let's just call it a speculation, right? Time frame is the only difference. So when we're losing, the fact that we hate to lose makes us not want to sell, because losing is tantamount to, selling is tantamount to losing. So when we're losing, we become risk seeking. We take on more risk to avoid selling, okay? So we'll double down, we'll turn a short-term trade into a long-term investment. I got tons of great stories of clients, rationalizing their losses to me. Then conversely, when we are up on an investment, our loss aversion attaches itself to our profits. And so we become fearful of losing our profits, or risk averse with our winners. So we're risk seeking with our losers. We're risk averse with our winners. Meanwhile, markets can remain irrational longer than we can remain solvent in both directions, right? Up or down. And so we essentially have this kind of built-in behavioral bias that allows us to be victimized by 5 standard deviation events to the downside, and not enjoy comparable, victories by 5 standard deviation events on the upside. And so, to me, that is one of the biggest things that anybody involved in the markets needs to understand and needs to mitigate. And that's why I say it's a lot less complicated than people make it out to be. You really have to have a system with an edge, and then you have to make sure that you are not risk seeking with your losers and risk averse with your winners. And I think in many ways, that is the recipe for success.
Yeah, absolutely. And indeed, in breaking news, for all those investors who invested within 20% of the all-time highs of the Japanese stock market, only 32 years later, you're only 3,000 points out of the money on the Nikkei Dow after it's been up to 39,000 and all the way back down to whatever it was, 7,000 or something was the low. So yes, I mean, the prospect of doubling down is quite sensational, because you can manage to lose so much money as you go along. And certainly the risk aversion issue is key. I think the one thing that is interesting, what you were talking about earlier in terms of discussion about access to the markets and costs are cheaper. Totally agree. I mean, cost to access the market is much cheaper. But of course, there's one whole issue between what is cheap and what is free, which we've been talking about in the show before. We'll get back to it in a minute. But I actually think, the biggest oddity that's going on has been, until very recently, the inability of the financial markets establishment to appreciate that pretty much if you give people a generation, 20 to 40 years, they will tend to learn the stuff that was regarded as being the near quantum theory of the previous generation. That's how knowledge drips down, because you went to Berkeley and you studied all these incredible names, and you're reading about people, you're reading by people like Kahneman, Tversky, and so on, who've now become much more popular, and gradually they'll feed in. And indeed, as you've mentioned inadvertently or deliberately, but en passant, John Maynard Keynes a multiplicity of times, and nobody was really paying attention to what he was doing in 1946 to 50. But that was the point in time when he was starting to get all of this stuff out there into the outside world, if not before. And it's fascinating, because the financial establishment in the whole GameStop thing, I thought was very funny, because they can't cope with the idea that, for example, lots of retail investors have started trading derivatives, futures and options. And this has always been a point for me, because I used to have lots of arguments when I used to appear very often on things like CNBC. They were apoplectic if you said, well, this thing's happening in the options market, and it's interesting because it's going to have an impact on this stock for 2 days. And they go, no, can't talk about that. And 50 retail advisors who appeared once a month on CNBC would all write in and essentially no platform me, even though that was sort of 20 years before anybody got around to no platforming. And it was very interesting, because the simple truth was this information was going to come. And if you go to YouTube tonight and you're not watching IPO-VID, the chances are that there are 50,000 videos teaching you how to trade options that are going to be there. Now, some of them are pretty shonky, but a huge number of them are actually remarkably well done. I'm not suggesting those people are total experts in everything they're talking about, but they're certainly at the same level of understanding as the car sites where they're telling you how to tune your Chevy or whatever, and those are mostly retail names, and that's a big change for me. In the knowledge base in the digital world is changing what we know.
Yeah, I think you're right. I think that is an encouraging part of what's going on today. How many people even knew what payment for order flow was 6 months ago, right? But now it's actually entered the public consciousness. So I am, I'm really excited about the next generation of investors and this interest in the markets among, younger people. And I think you're absolutely right that they are learning a lot as they go. And, I certainly hope for more and more transparency from existing institutions instead of, more regulation. Because I think if you dish it out to the younger generation, that they're going to soak it in like a sponge. They are showing profound interest in the markets, and I think they're really excited about it. And I think if we get them really engaged, that would be excellent for our economy and for our future. My big fear right now, Patrick, is that we're going to see something like a March 2000 .com bust. and that a whole generation of investors are going to get turned off by the markets. And I think that that can happen if we don't really educate people, if we kind of allow this knowledge gap between more experienced market participants and new market participants to lead the market to unbalanced extremes. And that's a real concern for me, because this does feel reminiscent of 1999 and 2000, what's going on in the markets right now, if you were involved at that time, which I'm sure you were, and I know it's different, but it's also familiar, and there are 20-year cycles and, history may not repeat, but it does rhyme. And, so how can we help young people really, how can we capitalize on this interest of young people in the markets and really bring them along, so that they don't have to kind of, go bankrupt a few times before they really establish a balanced and effective relationship with capital markets? That would be, something I dream about.
Yeah, I think you're absolutely right. And I think the other thing is another strand also is possibly the fact that a lot of the people investing at the moment via the GameStop Wall Street Bets craze have been people that previously invested in highly speculative instruments, which were actually off exchange. I mean, they were on the pink sheets, maybe they were on CFDs, they were on spread betting, they were on foreign exchange trading. Now they're in markets. And I think that's the best thing, that they're with us in the regulated world, and we want them to succeed. And I suppose, therefore, we're going to segue a little bit. We'll come back to the retail traders in a second, because we've got a great question from Thierry Duranton. Hello, Thierry. Good evening. Thank you very much for your question this evening. So it would be interesting to ask Dr. Richard Smith's point of view and what he feels about Bill Gates saying Bitcoin is only for billionaires like Elon Musk. So what do you reckon?
I think that's absurd. So I think Bitcoin is here to stay. I think that Bitcoin and cryptocurrency and blockchain in general are essentially going to be the basis for a new internet, and it's an important part of our future. So at the same time, that does not mean you go back up the truck and buy Bitcoin, at $50,000 a Bitcoin, right? So you have to, if you're not involved, it's a great time to get involved, but this is exactly where the risk management comes in. I interviewed Jack Schwager through with the Foundation for the Study of Cycles a few weeks ago. And he said, when you ask Jack, the author of all the Market Wizards books, what do all the market wizards have in common? And he says, well, the only thing they really have in common is a pretty rigorous commitment to risk management. And then he went on to say that 90% of risk management boils down to knowing when you're going to sell before you buy. Okay. Right. So he took that from Bruce Kovner. That was a quote from Bruce Kovner. And so if anybody is interested in Bitcoin today, you have to ask yourself, well, when am I going to sell? Right. So if you're going to buy, even one Satoshi, right? I mean, you can buy $5 worth of Bitcoin. You don't have to buy a Bitcoin. You don't have to buy $50,000. You can go on a weekly, dollar cost averaging acquisition with $10 a week, whatever your budget is. But you do have to be thinking about, when are you going to sell? And if you ask yourself that question, you might say, well, I have no idea. I'm just getting started out here. I don't think I'm ever going to sell. Great. Well, that's going to tell you how much of your money, you can afford to put into something like Bitcoin. Because if you don't know when you're going to sell, then you basically have unlimited risk, and you shouldn't put more money in than you can afford to see, to never see again. Right. Yeah. So these are the questions that people need to ask themselves. And, if you say, well, I'm going to sell it at $100,000. Okay. That's a fair answer. It could go to $100,000. But I think if that's your target, then you have to be willing to also see it go to $25,000 or even $10,000. and you can live with that. So being able to think in this way, to think in terms of reward and risk, is, I think, a huge key to success in the markets, and something that I'm certainly trying to be part of, bringing that education and that solution to people, so that you can ask questions like this about Bitcoin in a more coherent and resilient way.
That's a great answer. Thank you very much, Thierry Duranton, for the question. Thank you very much, Richard Smith, for your extremely elucidating answer about the whole topic. If you'd like to ask a question, drop in, ladies and gentlemen, on social media and ask us a question wherever you're watching this live stream this evening. We'll be delighted to put your question to Richard. We got one slightly more general question, taking us back into the cycle discussion. We're jumping around this evening. Ron Beat, and hi Ron, how are you this evening? Do cycles really work, or are we just curve fitting? I suppose that's in answer to your comment about the way that you've been analyzing recently.
I've personally had a lot of success with cycles. At the foundation, we use statistical tests of significance. There's the Bartel's test in particular, which has always been at the heart of how the foundation does its cycles analysis. We do the sine waves, which sine waves match the data best, the detrended data, but then do tests of statistical significance on those sine waves. And to me, cycles are kind of like a wind sock at an airport, okay? So just because you have a headwind doesn't mean you can't take off, right? Like prices can rise into a declining cycle, no doubt about it, right? But you still want to know which way the wind is blowing. And I think that's what cycles help to do. Now, cycles can be extremely seductive, right? Sometimes you get these cycle calls that are made years in advance, and it just seems like pure magic. And you get completely seduced that maybe you found the holy grail. And, I think that's the wrong way to approach it. So bottom line is, cycles do work. I don't use them by themselves. Of course, I always use them with risk management. And I tend to use them, to confirm other things going on, especially around sentiment. I mean, if you look back to, say, well, let's take now, right? So obviously, you've got a lot of froth in the markets, a lot of extreme speculative activity. Levels of call option buying versus put option buying, that haven't been seen before. Penny stocks going nuts, Bitcoin at $50,000, and then you look at that in conjunction with the fact that the S&P 500 is nearing, a significant 2-year cycle top, and that gives you a little more pause about, well, I probably shouldn't be backing up the truck and buying right now. So that's the way that I've historically made the most of cycles. Cycle bottoms tend to be more predictive than cycle tops, I found. Maybe that's just because markets overall are trending up, I'm not sure. But in March of 2020, last year, when we saw the market down 30-40%, I was looking at cycles, and the fact that cycles were bottoming, right around that time, mid-March, was something that gave me a little more confidence to do some, dipping of my toes and, then knees into that water. So I think cycles can, in conjunction with other things, be a very useful tool for people to make better decisions in the markets.
Cool. Thank you very much, Ron, for the question. Great answer. And so to move, jumping around here, I mean, we've touched upon Bitcoin, touched upon there are other issues. We'll get back to that, I'm sure, in a moment. We were in this discussion about market structure, and we touch upon one thing, which is this concept of free. Well, I'm sorry, are markets really free?
Well, I don't think so. I am very concerned about this, free services model, the user as product business model, right? Which has primarily come out of Silicon Valley, but it really drives a lot of the economy today. And certainly the technology platforms, and, Robinhood is a technology platform. Market makers, wholesalers are technology platforms today. These companies have incredible computing power, right? And so when you have, certain parties that have unique access to data and unique access to get insights from that data that the rest of, the public doesn't have access to, I think that can lead to some distortions that frankly concern me, so I don't think free is free. I don't really know what to do about it, Patrick, because, ultimately I do believe in free markets and I think that people should have a choice. I guess what I'm trying to do about it is just help, be part of that education conversation so people understand better the trade-offs that we're making when we essentially give up our data, right, in exchange for other services. So that goes back to why I think Bitcoin is very important to the future of our economy, because I think increasingly people are realizing that their data matters and their data is valuable, and not just to sell for $15 over the course of 12 months, to advertisers, right? But data is what drives our economy today. And we are all producing and generating data of our own continuously, right? And that's being gathered and analyzed and modeled and, used to basically predict and shape the behavior of populations. And, I personally feel uncomfortable about that. How about you?
Oh no, I mean I'm with you there, because I think the issue of where we're at. In fact, actually, I'm going to give myself a plug at this point in time. Victory or Death, my book, because I'm discussing the future outlook of Bitcoin and where I think it's the Model T Ford of cryptocurrency still. And also, I think you look at the idea of how much data there is around. I mean, it took us a long time to generate a petabyte of data, and then all of a sudden, we had someone on here 3 weeks ago, which is Paul Humphrey, who's the chief executive of BMLL, who are a big data company, genuinely, and they've got a 15 petabyte lake of data just about UK and US stocks and other stocks around the world. I mean, you look at how long, that data is incredible. I think you're in a great spot with the data questions, and actually we've got some interesting questions coming in on the risk management side. So let's get to it. Martin Watkins, previous guest on this show. Good evening, Martin. And indeed, I presume that you're sending this to us today from, in some ways, one of the homes of cryptography in the United Kingdom. For all those of you who watched that show all those weeks ago, what are the lessons to learn when adapting conventional risk models to accommodate digital asset, stablecoin, and cryptocurrency cycles?
I try to keep it really simple. I know that at institutions, there's a lot more complex models than what, the public is likely to use. So especially to actually get the public to use risk management, we have to really keep it simple and make it engaging. Bottom line is I pretty consistently just use things like volatility budgeting myself and standard deviations. I love Jack Schwager's work on gain and pain ratios. So, I don't see a lot of difference between, traditional stock market use of volatility, Sharpe ratios, et cetera, to applying them to the cryptocurrency markets as well. Some of your audience, Patrick, I'm sure, has more sophisticated analytics than what I've been, trying to bring to the public's attention. But I kind of treat it all the same myself, and I like to keep it really simple.
Excellent answer. In other words, for all of the technology that there is out there in the world, you can still manage to apply trailing stops to digital assets, as you were doing with trailingstops.com all those years ago.
Yeah, well, you have to factor in the volatility, right? So one of the first things I did was I developed a volatility-based stop loss strategy. And, you have to look at how much the price goes up and down, right? And so obviously cryptocurrencies are extremely volatile. And sometimes, trailing stops are kind of meaningless on that level. So I think that it can work. I haven't used trailing stops that much on cryptocurrencies. I think this is more of a kind of buy and hold situation right now, or a buy and hodl, so to speak. And for something as transformative as this, it's kind of an all or nothing bet. So I think cryptocurrencies are a little more volatile than you can easily apply traditional metrics to successfully. But I do think, like I was doing some studies this past week on just looking at how, Bitcoin could complement an existing stock market portfolio, right? Like, people approach this as an all or nothing question, like Bill Gates saying, Bitcoin's only for billionaires. No, you can actually, it's an asset class practically, right? And you can incorporate it into an existing, portfolio. And it can actually, even though it's more volatile, it might actually dampen down your volatility a little bit because it's not correlated to your other holdings. So, those simple things are still the most powerful things. And going back to, an earlier question about curve fitting, when you introduce a lot of variables, and a lot of complexity, you're at much higher risk of curve fitting, than if you just try to keep it simple, stupid.
And indeed, it's interesting, as you say, given that Bill Gates was a man who managed to diversify his portfolio across one operating system in one type of computer, right. The world's richest man, when you think about it. I hadn't thought about that until you put it in my mind just a second.
Great point. Great point. Yeah, I do think you need concentration. If you want transformation, you do have to take that risk of concentration. But look, it's reward and risk. You got to understand both. You can't just be thinking about the reward. You got to think about the risk, and you got to think about the relationship between the reward and the risk, and how most people don't realize that you can tune that, that those are dials that you can turn. And, on the one hand, calm yourself down a little bit, so, to me, the biggest thing, Patrick, is we have to get ourselves in the right mindset, right? We have to be, able to kind of withstand the siren songs of the markets, right? And that's all about expectations, having expectations that are not completely out of whack with market history. And if people just understood expected value a little bit, weren't so prone to having their expected values, distorted by the media and then arbitraged by the technology, I think they do a lot better.
Which leads us beautifully to the next question. So we've got a question from Mark Pilkington. Good evening, Mark Pilkington. Somewhat breaking the glass ceiling. Sorry, that was a terrible pun. What are the pros and cons of artificial intelligence applied to risk management?
Well, I think that there are a lot of risks in that. I think that artificial intelligence, I've never really been a fan of that word. I don't really believe there is artificial intelligence. Going back to kind of Jared Lanier and his critique of Google and Facebook today, they're actually applying machine learning to human intelligence and kind of modeling that, right? And I think that there are a lot of assumptions that are get built into those models that aren't apparent in the models until they are. And I think we've actually seen some of that this year, Patrick, in the markets with firms like Renaissance Capital, having a tough year for the first time in a while. And, models are great until they aren't. Black boxes are great until they aren't. And artificial intelligence, is a black box in many ways. So I have concerns about that. I think there are real cons, and I think we have to be careful. Obviously, there's pros to it too. and I studied neural networks, genetic algorithms, chaos theory. That was all fun stuff. I was at the Santa Fe Institute for a while studying complexity science, and I loved it. It was a blast. But you know what? Those guys who were trying to model markets way back then using all that stuff, they went out of business. So look, we can't stop this train. It's out of the station. It's a part of life, but I think it's a huge mistake to overweight its significance. I was listening to a podcast the other day of Tim Ferriss, right? Interviewing Jim Collins, the Good to Great author. Mm-hmm. And Jim Collins was talking about Peter Drucker, and the Effective Executive author, and of course, management guru, extraordinaire. And he said Peter Drucker's, driving question was, how do we make society both more productive and more humane? And I think that's a really important question today. And I think that we've certainly made incredible strides in productivity, but I think we're at risk of, jeopardizing our humanity. And I think there has to be a balance between those things. I think that's part of what the Foundation for the Study of Cycles is about. Again, it's about people, right? It's not just data. Machines don't replace people. And there's a, broader societal discussion about the relationship between technology and people that I'm happy people like you are out there having that conversation and stimulating it.
It's a fascinating issue altogether. And actually, you raise a great question. I'd forgotten about that. Somewhere I've got actually 4 or 5 copies of a book signed by the late great Professor Mandelbrot. And yeah, you're right. I mean, all the chaos mathematicians have all of a sudden kind of just disappeared. I mean, right. they were whisked away on a melting Koch snowflake or something. I hadn't thought about that. It's interesting and fascinating to know you worked at the Santa Fe Institute, or you researched at the Santa Fe Institute for a while. That must have been incredible.
It was a lot of fun. And that was back in, the late mid-90s or so, when a lot of this stuff was coming online, right? And yeah, it was great fun.
Amazing altogether. Well, look, I mean, we were talking about this whole retail issue in the middle, and you've talked about the arbitraging of retail investors, which I think is a very interesting, very, very interesting and pithy way to put it. And we're talking about free markets and also the issue of free in that respect. So where do you actually stand then on this very controversial, suddenly hyper-controversial payment for order flow debate?
The thing that concerns me, and I haven't heard anybody talk about this yet, Patrick, except me, is that, payment for order flow, it's been around for a long time. There's price improvement. I get it. Larry Tabb was just sharing that $3.7 billion in price improvement was handed back to retail investors this year. That's great. But it just concerns me that we're driving the public into transactions for the sake of transactions, right? Mm-hmm. Are you saving $3.7 billion if you put $100 billion in the market and you lose $20 billion, right? So, Robinhood CEO in the hearing said that his data shows that his customers, are ahead $35 billion of their net, deposits. I would love to see more of that data. I do think that there is some hope that younger people are engaging in the markets more effectively. A lot of them didn't sell in the downturn of February and were actually buying instead. That's really encouraging. But, Robinhood makes its money on payment for order flow as a percentage of the spread. So to me, that pretty clearly incentivizes them to benefit from wider spreads and more illiquid instruments. And if we look at the GameStop, episode, I think we had some of the widest spreads in history in the options market, which I think provided tremendous, revenues to Robinhood when those, numbers come out in a month or two. So that structural incentive of a retail broker-dealer business concerns me. It's hard to see for me how it's aligned with the best interests and outcomes of retail investors. And I would love to be proven wrong, man, but it does concern me. I wish more retail business models were actually made money when their customers made money instead of just when their customers transacted.
Yeah. Well, it's certainly very interesting given the fact that actually, in order to give that price improvement, you take the orders away from the open market. So therefore you lose the equivalent of the amount of business midway between the amount of business transacted every day on NASDAQ and NYSE ends up not happening. And you wonder, well, what would the market look like if that was actually all happening in one open market instead of going down this funnel towards payment for order flow, which is the area where I really start to have a problem, because all numbers are big in the modern stock market. So therefore it's 3.7 billion. It's one of those things where sooner or later we'll be saying, well, that was in the days when 3.7 billion was big money. And that's where I think we're at with this multi-trillion gazillion dollar stock market. We're in the last 10 minutes here, ladies and gentlemen. I'm with Richard Smith. He has been illuminating us on a multiplicity of different topics during the course of the evening. He's the doctor of uncertainty, is the way he's been described, and he's been discussing a huge amount of insights into markets, into cryptocurrency, and into all sorts of other issues relating to the retail trader flow. So we're trying to promote retail trader longevity. That's actually going to be something we're going to be coming back to in a couple of future IPO-VIDs, ladies and gentlemen. We're very interested in this whole technological change. You described yourself as a fintech entrepreneur in your bio at the start of the show. Tell us a little bit about how you see financial technology changing markets, and how is that impacting upon retail investors beyond what we've been discussing?
Well, I think we've pretty much succeeded in facilitating access to markets. And I think that's a lot of what technology has been about over the past 20 years. And I think there's a new level of technology that is still ahead of us. I don't know if you'll like this analogy or not, Patrick, but I see a big analogy between the financial markets and the food industry. And I think at the retail level, financial markets have a lot in common with fast food restaurants from what we've seen, from 25, 30 years ago when you and I were kids, right?
Yeah.
So, it's a lot about the sugar and salt right now. And, over the past 20 years, there's been a lot of evolution in our thinking about health and nutrition. And I think that there's a similar movement starting to happen, in financial markets and capital markets, where people are starting to think about, what's sort of the analog of organic foods in the capital markets, right? Because that's how you get longevity, right?
Yeah.
And it's not like you're just eating broccoli, but you're cutting back on sugar, you're cutting back on salt, you're doing a little exercising, you're aiming for longevity, for resilience, for 80 years of good living or more, right? And how do we start to think that way about our financial lives? And we've seen such huge strides in technology, especially around fitness and dieting, et cetera. And I think that same kind of design and behavioral approach to, fitness and nutrition and health has a big place in the financial markets. And that's something I'm personally really excited about. How do I get, for example, people to always answer the question of when am I going to sell before I buy, right? So when Jack Schwager says all the market wizards have that in common, that they use risk management, and 90% of risk management is knowing when you're going to sell before you buy. Well, in one action, you can take a step 90% of the way to putting yourself in the company of the market wizards.
Yeah.
Talk about simple, man. So, that's where I think the next opportunity in technology lies. The data warehousing is there, the analytics are there. Now it's how do we help it actually reach the individual decision maker so that they can make coherent and resilient decisions, not just, in one trade, but over a lifetime of healthy engagement in the capital markets.
Just quite a fascinating concept in terms of the analogy with the food industry. I hadn't thought about it like that, but I think it's a very interesting one. Although at the same time, it's kind of interesting because therefore that means that in some respects, the people who are promoting this must be the sort of the West Coast hippies of the 1960s looking for a Whole Foods market. But it is fascinating in terms of how that develops. So then let's look at the new technology. Let's look at things like you've talked about Bitcoin. Now, you seem to me to be, you're pro Bitcoin, but certainly pro cryptocurrency. Mm-hmm. Talk us through that. Where do you think that potentially plays out to? And what's the advantage for people in that cryptocurrency economy?
Well, again, I think it boils down to data and data privacy and data autonomy and data sovereignty, right? So you have all these models driving the economy right now where a very small group of people essentially have access to the data that the rest of us don't, and they have data that the rest of us don't, right? So that's an issue of privacy for me, and I think that as people come to appreciate that more and more, that data is going to really start to be treated as a currency, right? And you do that with blockchain, and you do it with cryptocurrency, and and the Internet of Things coming online, all these devices having to transact with one another, that's where it's going, right? And so you have to be able to transact in less than a penny. That's very hard to do on the internet right now. And I think that's what blockchain crypto are about, to really give people more control and more autonomy, and not just people, institutions. I'm an investor in a number of companies that are developing privacy solutions for corporations to be able to better control and disseminate their own data. You have, Facebook and the Australian government going, nose to nose right now. And Facebook, looks like they backed off a little bit. So these issues are coming to the fore. It's more and more a part of our future. We have to be able to have sovereignty and control over our own data. And I think that's really what blockchain and cryptocurrency enable. That's their core contribution to the future economy. And I just think that's, coming at us fast.
How fascinating. So an innovation economy, but at the same time, you need to keep it simple. We're looking at the whole concept of an 80-year cycle within the Foundation for the Study of Cycles itself, which, as I mentioned earlier, is a handy full-length Kondratiev wave plus a decent Fibonacci number. We've turned full circle, but yet at the same time, we still have this problem of the fundamental, perhaps, stubbornness, the failings of the human condition, let's put it that way, when we're looking at the whole business of loss aversion, which remains at the epicenter of what's going on. I really enjoyed your fascinating pointers in relation to the whole concept of artificial intelligence. Thank you, Mark Pillington, for that great question. You're standing and you are in the footsteps of the great Edward R. Dewey, and you're a very modest participant in the Foundation's study of cycles. And I really applaud you for that, Richard Smith, given the fact that you understand so much about what's going on with our markets themselves. And in every possible sense, I think it's interesting because, yes, we have had, as you said, success in facilitating access to markets, but we're now on this cusp of a fabulous wave. Hopefully, this is the upcycle to managing to help a new wave of retail investors understand better, to follow what's going on in markets and be able to invest better. And I think that's an absolutely superb and happy and interesting and thought-provoking and upbeat note on which we're going to finish today's show, because it's been quite a sensational discussion with a lot of data density during the course of our conversation. I very, very much appreciate that. Thank you very much, ladies and gentlemen, for watching. Thank you for hitting that like button. Thank you to those of you who were asking questions this evening. Rombeat, Martin Watkins, lovely to see you again. Thierry Duranton and Mark Pilkington, amongst others. I hope I haven't missed anybody else out. I want to say thank you very, very much to the Doctor of Uncertainty. I have to say this evening, you've actually been the Doctor of Enlightenment at the same time as sprinkling a little uncertainty across our lives. Richard, it's really been a pleasure to have you during the course of this show. And well, at this point in time, ladies and gentlemen, what can I say? Thank you very much to the production team this evening. Thank you, Veronica. Thank you, Ola. Thank you, Beata. Thank you, Claude, and indeed also Pippa, for all of your hard work. We've got a couple of sensational shows coming up in the near future. Next week, we've got a triple header. It's the whole stack of digital assets. We're going to have representatives of Expiry, the exchange technology provider, Bay Markets, the clearing, central counterparty clearing technology provider coming from Scandinavia, and we're also going to have a representative, Eric, from Digital Asset. They're going to be talking about the digital asset stack and how you can manage to use that going forward with your new style digital markets. Coming up, the Brexit debate continues on the 9th of March. We mentioned last week the City United project. Its chairman, Daniel Hodson, himself an esteemed former chief executive in the City of London, of one of the London leading exchanges of the time, Life. Daniel's going to be joining us here. We're going to be talking about the Brexit opportunity once more, following in the footsteps, of course, of that marvellous show we had last week with Barney Reynolds. Ladies and gentlemen, on behalf of myself, Patrick L. Young, and particularly this evening's magnificent guest, Richard Smith, the Doctor of Uncertainty, thank you very much for watching IPO-VID live stream. We'll be back next Tuesday. And of course, in the meantime, don't forget you can watch this at any point in time archived. So therefore, if you're watching it next week, I hope you're enjoying Bitcoin, which is obviously going to be priced at $175,000 or 4.75 or something somewhere within one or two standard deviations between. Good night, ladies and gentlemen.
Thank you, Patrick.